All right, dividend hunters. Let's talk about something that's been quietly building wealth for nearly a century while everyone else chases the latest shiny object. What if I told you there's a company that's literally moved mountains for 95 years, pays a dividend that's grown for 30 straight years, and just posted record revenue of $67 billion? You'd probably think I'm talking about some flashy tech giant, right? Wrong. I'm talking about Caterpillar, the yellow machine empire that most investors completely ignore while they're busy chasing meme stocks and crypto coins. Welcome back to Dividend Surge, where we surf the waves of American stock market wealth. Today, we're diving deep into why CAT might be the most underrated dividend aristocrat hiding in plain sight. Here's what blew my mind when I started digging into this beast. While everyone's obsessing over artificial intelligence and whatever Elon tweeted this morning, Caterpillar quietly generated $6.7 billion in free cash flow last year. That's enough cash to buy Twitter twice. And they're using that money to reward shareholders with dividends and buybacks. Think of Caterpillar like the foundation contractor for planet Earth. You might not notice them until you need to build something massive, but when you do, there's literally no substitute. Stick around because we're about to uncover why this industrial giant could be the boring investment that actually makes you rich. Let me paint you a picture. Every single day, somewhere on this planet, a Caterpillar machine is moving mountains, literally. From the copper mines of Chile to the skyscrapers of Dubai, from hurricane cleanup in Florida to massive infrastructure projects across Asia, CAT's Yellow Army is working around the clock. But here's what most people don't realize. Caterpillar isn't just an equipment company. They're a diversified industrial powerhouse with three distinct revenue streams that create an almost unstoppable economic moat. First, you've got construction industries, $25.5 billion in revenue last year. This is your bulldozers, excavators, and all the heavy lifting equipment that literally builds civilization. When governments spend on infrastructure, when companies expand operations, when disasters hit and rebuilding begins, CAT gets paid. Second, resource industries, $15.8 billion in revenue. This is the mining equipment that pulls copper, gold, iron, ore, and coal out of the ground. As long as humanity needs raw materials, and spoiler alert, we always will, this division prints money. Third, and here's the kicker, energy and transportation at $25.7 billion. These are the massive engines that power ships, generate electricity, and keep industrial facilities running. We're talking about mission-critical infrastructure that customers can't just switch off when times get tough. When you buy Caterpillar stock, you're not just buying an equipment company. You're buying a piece of global economic infrastructure. And that infrastructure generates cash flow whether Wall Street is having a good day or a bad day. Now let's talk numbers because this is where Caterpillar gets really interesting for dividend investors like us. Revenue hit $67 billion in 2024. That's a 4% increase year over year. But here's the beautiful part. They're not chasing growth at any cost. Operating margin expanded to 17.8%, which means for every dollar that comes in the door, CAT keeps almost 18 cents as profit. That's efficiency on steroids. But wait, it gets better. Free cash flow came in at $6.7 billion. Up 13% from the previous year. That's real money, not accounting wizardry. Cash they can literally count, stack up, and decide what to do with. And what are they doing with it? Here's where the dividend magic happens. CAT returned $3.6 billion to shareholders through dividends and share buybacks. That's over half their free cash flow going straight back to the people who own the company. The current dividend sits at $4.88 per share annually, which works out to about $1.22 quarterly. At today's stock price around $350, that's roughly a 2.1% yield. Now I know what you're thinking. That's not exactly a high-yield dividend play. But here's why that 2.1% yield is actually more valuable than some 8% yields you see out there. It's backed by a 30-year track record of consecutive dividend increases. This isn't some desperate REIT trying to attract yield chasers. This is a dividend aristocrat with the financial strength to keep raising that payout year after year. Over the past decade, CAT has increased their dividend by an average of 8% annually. That means if you bought shares 10 years ago, you're earning about 4.5% yield on your original investment today. That's the power of dividend growth compounding over time. Here's where this story gets really compelling for forward-looking investors. We're sitting at the intersection of multiple massive secular trends, and Caterpillar is positioned right in the sweet spot of all of them. First trend: infrastructure spending is exploding globally. The Biden administration's Infrastructure Investment and Jobs Act allocated $1.2 trillion for roads, bridges, broadband, and clean energy projects. China's Belt and Road Initiative is still moving mountains, literally across Asia and Africa. Europe is rebuilding its energy infrastructure after the Ukraine crisis. When governments write trillion-dollar checks for infrastructure, who gets the work? The companies with yellow machines and 95 years of experience moving dirt and pouring concrete. Second trend: the energy transition. Now I know what you're thinking. Isn't Caterpillar an old-school fossil fuel company? Actually, no. CAT is becoming a major player in the renewable energy build-out. Wind farms need massive foundations. Solar installations require land preparation on an industrial scale. Battery factories need construction equipment. Whether the world runs on oil, natural gas, solar, or fusion power, somebody's got to build the infrastructure. And that somebody uses Caterpillar equipment. Third trend: nearshoring and supply chain resilience. After the pandemic exposed how fragile global supply chains really are, companies are bringing manufacturing closer to home. That means building new factories, expanding ports, upgrading transportation networks, all of which requires heavy equipment that lasts for decades. Fourth trend: the mining supercycle. Electric vehicles need lithium, copper, and rare earth minerals. Green energy infrastructure needs massive amounts of steel and concrete. Data centers need cooling systems and backup power. The world is going to need more raw materials in the next 30 years than we've pulled out of the ground in all of human history. Caterpillar isn't just riding these trends. They're the essential enabler that makes all of them possible. Now let's talk about why nobody can just show up and compete with Caterpillar tomorrow. This company has built what Warren Buffett calls an economic moat: sustainable competitive advantages that protect their business from competitors. First, there's the dealer network. CAT has over 170 dealers in 190 countries. These aren't just salespeople. They're service centers that can repair, maintain, and support CAT equipment anywhere on the planet, 24/7. When your million-dollar mining truck breaks down in the middle of the Australian outback, you're not calling around for the cheapest option. You're calling the CAT dealer. Second, there's the installed base effect. CAT has millions of machines working around the world right now. Those machines need parts, service, and eventually replacement. It's like selling printers and then making money on ink cartridges for the next 20 years. Third, switching costs are enormous. If you're a mining company with a fleet of CAT trucks, your operators are trained on CAT systems, your maintenance crew knows CAT parts, your logistics are set up for CAT supply chains. Switching to a competitor means retraining everyone, retooling everything, and hoping the new equipment works as well as the stuff that's been making you money for decades. Caterpillar isn't just competing on price or features. They're embedded into the operational DNA of their customers' businesses. All right, let's be honest about the risks, because no investment is perfect, not even dividend aristocrats with yellow machines. Risk number one: cyclicality. Caterpillar's business moves with economic cycles. When global growth slows down, infrastructure spending gets cut, mining companies delay equipment purchases, and CAT's revenue can drop significantly. We saw this during the 2015 to 2016 commodity downturn, when CAT's revenue fell from $55 billion to $39 billion. Risk number two: China exposure. About 10% of CAT's revenue comes from China, and U.S.-China trade tensions could impact that business. Plus, Chinese equipment manufacturers like Sany and XCMG are getting better and cheaper every year. Risk number three: environmental regulations. As the world moves away from fossil fuels, some of CAT's traditional markets, like coal mining, are shrinking. Though, as we discussed, the energy transition also creates new opportunities. Risk number 4, interest rate sensitivity. When rates are high, big infrastructure projects get more expensive to finance, which can reduce demand for CAT's equipment. These are real risks that could impact short-term performance. But here's what I love about Caterpillar. They've survived and thrived through every economic cycle for nearly a century. Recessions end, but the need to build things doesn't. So here's my take on Caterpillar as a dividend investment. This isn't a get-rich-quick momentum play. This is a get-rich-slowly wealth builder for patient investors who understand that boring businesses often generate the best returns. At current levels around $350 per share, you're getting a 2.1% starting yield backed by 30 years of consecutive dividend increases. The company is generating massive free cash flow, maintaining healthy margins, and positioned to benefit from multiple long-term secular trends. Think of CAT stock like owning a toll booth on the highway of global economic development. Every time the world economy grows, every time governments invest in infrastructure, every time companies expand operations, you collect a fee. Is it volatile? Yes. Will there be years when the stock goes nowhere or even declines? Absolutely. But if you're building a dividend portfolio for the long term, Caterpillar offers something rare. Exposure to global economic growth with a management team that's proven they can navigate through any economic cycle while still rewarding shareholders. Here's the math. If CAT can continue growing their dividend at just 6% annually, slower than their historical average, that $4.88 dividend becomes $8.70 in 10 years. On a $350 investment today, that's a 2.5% yield on your original cost. Add in potential stock price appreciation, and you're looking at attractive total returns for patient investors. Look, Caterpillar isn't sexy. It's not going to triple overnight. It doesn't have a charismatic CEO tweeting about Mars or a revolutionary app that teenagers love. What it has is something better: a 95-year track record of profitability, a 30-year track record of dividend growth, and a business model that's literally built on the foundation of global economic development. For dividend investors who value consistency over excitement, cash flow over hype, and proven business models over promises, Caterpillar deserves serious consideration in your portfolio. Remember, this isn't financial advice, just my perspective based on publicly available information. Do your own research, understand your risk tolerance, and never invest more than you can afford to lose. What do you think about Caterpillar as a long-term dividend play? Are you comfortable with cyclical stocks in your portfolio, or do you prefer more stable dividend payers? Drop your thoughts in the comments below, and if this breakdown helped you understand CAT better, smash that like button and subscribe for more dividend analysis. Next week, we're exploring why Realty Income might be the monthly dividend stock that could replace your paycheck. You won't want to miss it. Sometimes the best investments are hiding in plain sight, painted yellow, and moving mountains one dividend payment at a time.